So we are done with our perspective of business firms. Now we will talk about the perspective of investors. So what investors are thinking, that what will can be their risks are. So here there are two type of risk we can see. The first one is interest rate risk and another one is liquidity risk. So these two are risks. Among these two, interest rate risk may be a little bit of complicated. At the same time, it is pretty easy to calculate. So let's go for the details. So over here I have already said that if you face any sort of fluctuations in interest rate, then you may face the risk of your interest rate. For example, you are an investor of a company. So here when you buy the bonds or debentures, then you have to face the interest rate risk. So here what is the reason? The reason is that the value of your investment all the time moves upwards and downwards based on the time that you will involve with your shares company from where you have bought already your bonds or debentures. So here if you see any sort of fluctuations, then it will be the interest rate risk. So if interest rate is high, then the market price will be lower, and also if you face interest rate decreases, then the market price will be higher. Market price means the value of your investment. So mainly if you face that the interest rate decreases and your value of the investment that you already invested in the company, that will basically shows you the interest rate risk. So let's come with the liquidity risk. We know what is liquidity. Liquidity means how fast or how flexibly you converted your investment into cash. So when will you face this type of risk? When you face this if you unable to make the short-term debt. Why we are saying this? We are saying this because there are all the time when investor invest in the company, they may need cash emergency. So if you cannot fulfill their needs immediately, then maybe you will face the short-term debt. Because investors why investors invest in your shares? Because they want this type of flexibility that you can provide. So if investors cannot get their immediate money by selling their shares or bonds or debentures, then maybe you will meet this short-term debt. The second one is unable to meet the funding at specific time. Why we are saying this? This is for the emergency time or urgent time. For example, I am an investor in your company. So it is very uncertain that when investors want their money instead of their investment. For example, I am saying this after 1 month, I need my money back immediately. So this 1 month is a specific time because I have already informed that after 1 month I will get back my cash instead of the value of my investment. So if you are unable to meet this specific time, then maybe you will face the liquidity risk. So over here, this liquidity risk basically involve when you fail to repay the cash instead of the value of the investment that you have already invested. So this is very risky for the sole proprietorship. It means you own your business and you have to repay or you have to sell your product by your own, and the partnership business. These type of business are in risk when they face this type of liquidity risk. Also, when because why is that they are very risky? Because they cannot sell their fixed asset immediately at a reasonable price. A reasonable price means what they're expecting after selling their assets. at a specific time period. Specific time period means when I'm saying you that as an investor I need my money back after 1 month, then this 1 month is your specific time period. And if you are unable to give me my cash or the value of the investment at a reasonable price, then liquidity risk may occur. So if you, here is a very little bit advantage you can say you may get, like if you buy the share from the company, then you can immediately, or you can buy or you can sell your investment or share at any time, and you can get your money at any time in the secondary market or share market. But here is a problem: if you sell your share to the capital market and you have already involved in the banking activities, or you can say you have already involved in the foreign businesses, or you have import export businesses, then there may be a little bit complexity you may face, because every debenture or bond holders has the limited buyers of the company. So if there is no way to exit these limited buyers, so from getting back money from them will be then very time consuming and frustrating. So that's why we are saying this is liquidity risk. The main thing is if you are unable to meet the short-term debt, and if you are unable to meet the funding at specific time, and most importantly not the least, inability to convert investment into cash, then this is all about called the liquidity risk. This is the main concept of the liquidity risk. But if you invest your money in the share market, then you can get back your money very quickly, whenever you want, whatever you want you will get at a reasonable price at your specific time. But for the capital market you cannot do this, because they have a very limited buyers for their market. And the more important thing is, if you involve in banking activities or any sort of foreign type of business, then that will be the time consuming and very frustrating.